what makes a gem? A special company with an attractive price doing something different. I think what I've definitely refined since we started the fund and versus my past life running other funds, in this world of higher interest rates, scarce capital, outflows, it's pretty barren. Companies, their shares, it really had to command capital. And when I did a sort of 3-year review of our first 3 years at the start of this year, the stocks that had won were sort of what I call world beaters on a London rating.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I am Merryn Somerset Webb, and with me today is Laurence Hulse, who is founder of the investment company Onward Opportunities. This is a rare beast in this relatively recent launch of a long-only trust which specializes in UK small caps, one of the most unpopular parts of the global stock market. So we talk about why he launched into this sector, how he's done it, and how he makes his returns. Laurence, thanks for joining us today. It's very nice to have you with us.
Good afternoon, and thank you for having me here at the European headquarters of Bloomberg.
Where everyone wants to be.
Where everyone wants to be.
Now listen, we've got you on today because you've done something really interesting. You have actually, in really an appalling environment for the investment trust industry, managed to launch a new one. And not only did you do it, but it's actually gone quite well. So tell us about why you did that and how you did it.
I had spent 8 or 9 years at a business called Gresham House Asset Management. I was on the UK equities team there, investing in UK smaller companies. We had a good performance track record as a team. And it came to sort of late 2021, 2022, and I really observed that the financial world, as well as the wider world, was changing quite fundamentally, and that really hung around interest rates. You'd had, for the first period of my career when I was there, cheap money, lots of it, and it was really a multiple expansion market. Whereas I had been taught to invest during my time at Gresham House around catalysts and engagement and being a truly active manager. And in a world of rising interest rates, as was about to happen and went on to happen, those elements of an investment thesis become much more important because you can't, and as many high-profile managers are finding out at the moment, you can no longer rely on multiple expansion and liquidity to drive a thesis. And I spotted really a good old-fashioned gap in the market to do this for investors, for clients, using my experience at Gresham House, the time I spent there. They had a fantastic journey of growing products for clients. I got to witness that, take part in it. I was one of the original employees, and I combined that with the sort of stock picking techniques I'd learned there to launch a fund, and here we are.
So you thought you would launch into one of the most unpopular part of global markets, UK small caps, the one place that has been so cheap for so long. We've talked about it on this podcast for so long. We're constantly saying UK small and mid caps are ridiculously cheap. You really need to buy them before somebody else does, but it never really happens. This stuff just stays cheap. And it's also a relatively crowded market, getting smaller. But when you launched, there were still quite a few funds, and still are actually, trying to operate in this small and mid-cap area and in the main kind of failing.
You're right, there are quite a few, but we've been outperforming the majority of them, and at points in the first 3 years of our fund's life, outperforming them materially. And that really loops back to what I was describing before. We have got a slightly different or more specific specialist way of investing in these companies. And yes, many of them remain difficult and cheap, but some clearly aren't, given our investment returns since we launched. And it comes back to this idea of, I call them the gems amongst the rubble. Yeah. It is undoubtedly a difficult market. Yeah. That slightly appealed to the contrarian in me to have a go and resign and try and launch this at 29 years of age. We just about did, and it's gone on to good things since. But and I know you talked about this on the podcast before, therein lies the opportunity. I think the thing I'd love to add today for the listeners, beyond what's been talked about in previous podcasts, which is around how cheap it is, I think that's just the start of any investment thesis. I think what we've been showing and demonstrating alongside some other fund managers is actually what can you buy within that value. Yeah. And if you have a strategy like ours that is pretty concentrated, pretty hands-on. My sister, who's an artist, calls it brutalist investing. It's pretty pointy, it's pretty active, it's pretty energetic, but it delivers outperformance by foraging, rummaging, and finding those gems. And we have a really eclectic portfolio today of some of these companies are capitalized at less than 50 million, but their clients are some of the biggest companies in the world.
Yeah. Well, let's come back to that in a minute. I want to come back to exactly how you invest, how you find the companies, and I want to talk about a couple specifically. But before we do that, I want to stick with the structure of the fund. I mean, the first thing to ask being, who are your investors? Because one of the things that you hear constantly in the investment trust business is that you've got to have 400 million, 500 million, maybe at this point even 600 million to get any wealth managers in, for example. So to get those flows, you need to be pretty big. So if you're down at the much smaller end of that, you're really only looking at retail investors.
That is the law. And I think I was told it so many times. I would sort of wake up in the night seeing those words on my bedroom wall. But what we've shown is that there is a different way. And if you listen to someone like Andrew McHattie, who's quite a spokesperson in the industry, or Jonathan Davis, we were on his podcast recently, we've actually done something quite revolutionary in building a trust almost from the ground up, brick by brick, as you point out. And we actually have managed to convince some wealth managers with our pitch and our approach and our background and our performance that it's okay to just dip the toe. And I think just this week you had a podcast out, what's the future like for wealth managers? And there was a lot of talk about being engaged with your clients and taking them on a journey to demonstrate the value you're adding for them beyond a kind of robotic solution. I would take that a step further. We've, many industries, and as a relatively younger fund manager, I witnessed and experienced this. Things are becoming experiential, and even restaurants now, they're almost an experience to be successful. There's a little bit of that about this investment product, this fund. If listeners go on the website, they'll hopefully pick up on some quite fresh branding. It's designed to be very accessible, relatable. We have a dynamic, energetic board, who work for some pretty big hitters, Bill Ackman, Guy Hands. And because that's what's great about investment trusts. They can and are accessible. There's no minimum investment. There's no sort of hurdle. The minimum investment is the share price and having a retail investment platform. Rathbones, Callanish Capital, GPIM, they're all wealth managers that have now disclosed a greater than 5% stake. We had some seed money from my mothership, their clients, Dowgate Wealth, who are a specialist boutique private client business. And then the rest really was high net worth, sophisticated investors that I had met along the way in my career and really convinced to back something slightly entrepreneurial, slightly different, and then promised to thank them with outperformance, which we've so far just about managed to do.
So far so good. Okay, and they'll do that, those wealth managers, even though it's expensive. It has to be expensive because it's small, right? But if you look at the investment trust environment now, most people are kind of trending down to 0.7%, 0.6%, but at your size, you're still 1.5%.
They are trending down on costs, and costs are an input, and the output is investment performance. I think it's well documented on this show, amongst many others, some other struggles of active management, and one of them has been performance. And I talked about interest rates and spotting a gap in the market to quit my job and do this. Another thing I became aware of, and this isn't a criticism, it was an observation, as Gresham House grew, it became a big business itself, and we were starting to look after various funds across a team, and it was becoming a bit thinly spread. I want to be solely focused on this and make it a life's work, and to do that requires, full time and overtime of myself, the lead manager and the founder, but also the investment committee, which we'll hope to talk about later. We need to build out the team over time to dilute key man risk and add resource, and this is a sort of specialist high-end product and is priced accordingly. That will rule out a large swathe of investor, but the reality is this strategy can never be big enough to attract large swathes of investors.
Yeah. Okay, well, on that same subject, tell me about the performance fee, because I have to say, as everyone listening to this podcast knows, I really, really disapprove of performance fees on the basis that outperformance should be its own reward, because you charge ad valorem, and as the fund gets bigger and bigger and bigger, so does the income of the fund manager. So a performance fee shouldn't, I think, really be necessary. But what you've got is 12.5% over a 6% hurdle. And is that 6% nominal or real?
So a couple of points there. This fund can't get bigger and bigger. Realistically, it will never be bigger than 200, maybe in the fullness of time, 250 million, adjusting for inflation and asset price growth. So again, to that point around keeping the team aligned, fully resourced, fully costed, it forms what effectively becomes a bonus pot for the team and the investment committee on outperformance. The hurdle is 6, subject to a high watermark. It also resets every year. If you think some performance fees are what's called a compounding hurdle, so in this case 6, most of our peers are 6 or 7% in what we do in the small cap market. But our target returns are 15, and they've been pretty much that until recently around the Iran war. So you can quite quickly open up a very large spread to this compounding hurdle that then means nothing. So ours resets every year as well, on top of the high watermark.
On top of the high watermark.
Yes, correct. And we get asked, how have you done this? How have you grown a fund? How's it performed well? And I think you alluded to that at the start, difficult market. We live and breathe this. I do nothing else. I'm pretty selfish with my time. If it's not involved, if it's not something to do with stock picking, looking after the stocks we've got, or relating to finding clients, I just don't do it. And again, that was one of the reasons to spin out and do something entrepreneurial. There isn't time for kind of wider topco office agendas.
Okay, fair enough. We didn't actually mention the performance numbers at the beginning, so tell us the performance numbers now since inception.
So as we sit today, to the last fact sheet, the end of May, the NAV is plus 35%. That is net of some running costs. That's a net number of all those costs we talk about. It peaked at an even more attractive number of about plus 50 towards the end of last year, before Hormuz and Iran and the Strait, or Schrodinger's Strait as I call it with a friend, opened up or not, or closed. And that's materially outperforming our 2 peer groups, which we define as the Investment Association UK Smaller Companies Funds. That's the open-ended vehicles. There's about 60 of them. And it's outperforming the AIC UK Smaller Companies in peer group, which is the trusts that invest in small caps. And we're outperforming both by circa double through the life of the fund. And listeners can see that on our fact sheets and investment decks.
Okay, great. Let's move on to the more interesting stuff then, and how you do this. It's a big universe, UK small and medium cap, getting a smaller universe actually, by the way, as there's more and more companies are taking out of it. How do you find these gems among the rubble? What makes a gem?
What makes a gem? A special company with an attractive price doing something different. I think what I've definitely refined since we started the fund, and versus my past life running other funds, in this world of higher interest rates, scarce capital, outflows, it's pretty barren. Companies, their shares, have really had to command capital. And when I did a sort of 3-year review of our first 3 years at the start of this year, the stocks that had won were sort of what I call world beaters on a London rating. And we've had some particular case studies with some great returns, and it's because they've really been global businesses with IP, with great products, with great strategies that happen to be listed in London, and at that London discount.
Should we stop there actually and just talk about this London discount that we talk about on the podcast quite a lot, and it just doesn't go away? Why do you think that is?
I think it won't go away until flows return. I think it's a multiple question. There's plenty of great businesses in our portfolio, in other funds' portfolios, that are doing great things, and their earnings are going up. In fact, I got some friends at Shore Capital and Canaccord who deserve a shout out for helping me do the work. Before I came on, UK retailers, the small cap index of UK retailers, their margins are much higher than their US peers, and they trade on half the valuation. Same with the industrials and the construction stocks. But the problem, because it all sounds a bit too good to be true, has been growth. The US indices, the US stocks, all have much better growth prospects. And hopefully we'll get a chance today to talk about the current administration and environment in which the stock market sits. But in terms of the discount, I think it stays until there's fundamental policy change to make flows, or encourage flow, incentivize flows to return. And that's one of the reasons why a concentrated approach like ours has been able to outperform. I'm not going to be, sadly, today, one of the fund managers that comes on and says small caps are ready to rock and roll. That will come one day, and I can't wait for it, and hopefully I'll still be around. But at the moment, it's very stock specific, commanding got to command capital.
Okay. Well, let's you said we hopefully we'll talk about it later, but let's talk about it now. The policy changes that probably not this administration, but maybe a future administration could bring in that might change the direction of flows in the UK.
Before getting political, which I probably will.
It doesn't have to be political. We're just discussing.
Well, this is the point.
Just discussing policies that might or might not help the London stock market, which is hugely important to our economic growth.
Totally. And that's the whole point. You don't have to get political. Where a fund manager like myself, and frankly a citizen of the country, gets cross is, objective matters get really poorly executed, like when to have a budget. In twice in succession now, the government have effectively waited till the last possible moment to announce what they're going to do. Now, anyone with any grasp from a kind of GCSE level of business studies or economics will know that businesses love certainty and predictability. Well, delaying your budget for as long as possible is the opposite of that. But it's particularly painful when there's leaks and speculation, and there's an ability to front run based on said leaks and speculation and do real economic damage. I don't think it's a coincidence that since the build up to last year's as late as possible budget, that the construction sector has really been struggling ever since. Some of the PMI numbers are at pandemic levels. You listen to the house builders, the bricklayers, these are all real companies that we talk to on the stock market. They're tearing their hair out with frustration. It's just so incredibly unhelpful. And that's before you even get to some of the policy decisions that then get made so late.
What about things like signal policies, like changing stamp duty, abolishing stamp duty, or the Brit ISA, that kind of thing? Do you feel they would make a substantial difference, even if they were just there as signals that the administration cared?
I think the Brit ISA genuinely would. But again, there's the frustration. It was kind of semi-announced it was going to happen, and then it wasn't. So if you're a wealth management business or a wealth manager, it adds to this image of confusion and flip-flopping and unpredictability, uncertainty. And I think if there's one word you could use to define the UK over the past 10 years, it would be uncertainty. Whatever the Prime Minister, and we've had loads, whatever the Housing Minister, whichever department, it's been uncertain, hasn't it? And businesses crave certainty. Even if it's a bad number, at least then they can adjust the model accordingly and make a decision, even if it's to build slightly less homes or in a different cost base. So I think the British ISA structured the right way is a good idea. I know some listeners, some commentators will say, you're commanding capital. You're not, because I don't think anyone's saying you can't invest in other stocks. I think what people are saying is in an increasingly polarized, splintered sort of world and world economy, a big tax incentive should be domiciled, especially at a time when our economy and our market, and the stock market, by the way, isn't this sort of casino that some politicians would have voters, listeners believe. It's a capital allocation mechanism. We, myself, my team, we decide which companies to put money in so they can go and do things in the economy. And we need to be encouraging that, incentivizing that. A British ISA, something around pensions, those can only be good things, and signals, as you say, because of course, what I think would most likely happen is fast, dynamic, informed capital would follow that, because one of the big challenges of the UK stock market would be being fixed.
Okay, well, we can only hope. Let's go back to where we were on the positive stuff. Choosing the gems. What's the process?
So there's two sort of crosshairs or identifiers. One is a set of quantitative mechanisms. We use a tool called Quest, which is a cash flow modeling tool, but we use it in the opposite way of how it's designed to be used. So an investor like Terry Smith or Lion Trust, they will look for quality compounders through the cycle, generating cash flow returns from their assets above the cost of capital, reinvesting them well, creating more cash flows is the simple kind of summary. We actually look for situations in businesses where that isn't happening anymore, could happen, stopped happening, and go and ask ourselves why. And there's 6 different scenarios we trawl the market for once a month. You get 6 sort of shortlists, and then we spend the rest of the month shortlisting them into things that we should spend proper time on or not. So that's been historically the core of sort of idea generation. We do operate like private investors, so we try and find our own ideas, our own pipeline, rather than take the traditional inbound broker calls, which makes it quite unpopular, but it kind of works. And then the other, which is a little bit more recent, the past year or so, and this is a genuine benefit of artificial intelligence that everyone sort of wants to talk about at the moment. For years, I desperately tried to read every RNS, and for listeners that aren't familiar, RNS stands for Regulatory News Service. So every day, a company that's on the stock market, that has some important news to share, they have to announce it at 7 a.m. via RNS. And I used to try and read them every morning.
That's your whole day gone.
Yeah.
Because remember, a lot of things people have to put out in RNS are not exactly important.
Correct.
Or interesting.
And even with filtering out some of the sort of fairly vanilla or technical ones, it was just unsurmountable when trying to launch a fund and grow it. But the business I work at, Dowgate, brought in 2 sort of PhD types about a year ago to help our business take out costs through AI. And that was working fantastically. And they sit on a desk, a couple from me, and I overheard them talking about something. And I kind of twigged that they could automate what Laurence is doing every morning at 7:01, but in 30 seconds. So every day I get any of the RNSs that have some phraseology or words and other things I don't really want to share on here because it's genuine IP, and I get them in my inbox. I usually get between 1 and 5 a day, and I can read those over the course of a cup of coffee.
How much time has that saved you?
Couple of hours a day.
Has it? Interesting. So I was going to ask
or the reality is,
how are you using AI in your business? That's fascinating.
It's more than saving me a couple of hours a day. It's actually prevented me missing out by not doing the second hour because
other stuff is happening.
Because it's the world.
Yeah. Okay. Interesting. So we've got those things on the go. Could you maybe talk us through an example of a company that you've picked up, looked at it and gone, well, that's a gem, and then what's happened?
There's one that comes to mind because we're sat in a broadcast studio and that's what they do. In fact, I suspect some of your colleagues probably use their product. So there is a stock called Pebble Beach Systems. It flagged up on our screening system as a business that had some capital allocation questions. Very quickly, just to give some context, the business has a piece of globally leading software that allows broadcasters to, in what I call layperson speak, put content in a line. So when any of us watch a show or stream a live event, we get a continuous thread of basically various video streams. Behind that, on the other side of the screen, there are anything from 12 to 50 different cameras. Think of a football match or the tennis or producing a broadcast show. And all those feeds plus the adverts have to be sliced and spliced and moved around and put into almost in situ into a thread. For years, Pebble Beach had been doing that for traditional broadcasters. That's a market that's deemed in structural decline. So they started trying to invest in a new product. And I'm going to condense this for effect because I don't want to go on for hours and hours. And we do a lot of work to qualify these ideas. But long and short of it, they were generating great cash flows, but burning them all. And because of that, and the fact it was deemed a kind of legacy industry, broadcast media is treated like tobacco today in terms of structural decline. It was a stock with a 35% margin trading on a P of 5 when we found it. So we asked ourselves, why? What's the catch? What's going on? The catch was the stock market didn't believe in the strategy. They thought the new product wasn't going to work and costing lots of money. And they thought what they did already was great, but dying. And one of the things we do when we diligence an idea is we talk to people that basically know a lot more than I about what we're looking at. So in this case, we spoke to people in the broadcast world. And someone quite astutely pointed out to us that, yeah, no, look, the streamers are cannibalizing traditional television, but they're now going through an absolute arms race for live content, for sports. And that's because there's loads of reasons for that, which you can go on to another time. But the interesting thing about sports is even though you stream it, you watch it in a line. It's live. You don't just download it and watch it. It's continuous, like a traditional broadcast. Fast forward, lots of engagement, lots of due diligence, mothballing the previous product, which meant the margins and the cash flows got even better. The company announced in February this year it won an initial contract with a global streaming giant, I think were the words used, so it's probably one of 5 companies, that they didn't disclose, but it was for a sport they'd just won. Anyone that is keen sports and streaming will be able to work it out. We did. But what they do disclose is they also do the Six Nations for Amazon Prime now, the football. So all of a sudden, you've had a business with cracking margins become a world beater. And it was on 5 times PE. The shares have done well, as you'll see on the fact sheet.
How long have you had it?
18 months now. But still today only trades on a P of 10, and we think that can get better and better, because one thing we have learned at the moment, it's winning sort of marquee sports like the rugby or the one they won in February, which people have to go and work out because I'm not allowed to share it. But what's interesting, and we learnt this on one of our regular sort of site visits we do with the investment, there is a whole cohort of what you call sort of tier 2, tier 3 sports that are uneconomical to produce as a media format on a national basis. But actually, if you're producing it via a streaming platform to a global audience, the economics work to broadcast the volleyball season or niche parts.
What is a tier 3 sport?
I know, I'm going to be careful. But niche sports can now be televised and monetized, and that's all going to be work for Pebble. So just a classic case of gem amongst the rubble. Really cheap, world-beating product, listed in London, global earnings. And that's what this fund has all been about, and that's where the success has come from. And we have a really eclectic cast, from one of the largest podcast publishers in the world, topical because what we're doing today, to the UK's leading retailer of fishing tackle, to the market leader in...
Now, is fishing a tier 3 sport?
I bet it gets televised now.
I bet it does too.
But it wasn't before. So yeah, that would be something that wasn't traditionally broadcast on B Channel 4.
Yeah, so
sports.
Angling Direct is your second biggest holding.
Correct.
And that is, I mean, it's a huge hobby in the UK. Getting a bigger hobby in the UK, fishing.
Yeah.
Outside my comfort zone here, but my husband and my son are both great fishermen.
And they spend probably quite a bit of time doing it when they do.
They spend a lot of time doing it, and I spend a lot of time buying them
stuff. So
stuff.
I'm starting to find my sort of co-manager for the fund, because you're picking up our investment thesis here, which was really, very rarely have we invested in retail. But if you're going to do it, retailing fishing tackle is a damn good place to start, because it's a large hobbyist community. What's really interesting is you tend to have to go to the store to buy the bait because it's live, and therefore it's a genuine omni-channel proposition, and that ring fences it from some of the online. I mean, I don't think many people do buy fishing reels from Temu because they're quite complicated and expensive, but it sort of ring fences you from the Amazon effect. And you've seen that come through in, there aren't many retailers that upgraded profit forecast twice last year, but Angling Direct did, even after absorbing an unexpected employers' national insurance contribution of £750,000, and their profit target was 5. So that's quite a meaty.
Okay, and when you
bump.
found Angling Direct, we've just talked about why you hold it. When you found it, how cheap was that?
The market cap was roughly 20. They had net cash of 16, net cash of 14, and inventories of 16. So it was trading at a negative tangible net asset value. That one we invested in the depths of 2023. And I think that was the real bleakest nadir of UK smaller companies. But interestingly, that's the whole reason why we launched the fund. To one of your comments at the very start of the podcast, why on earth have you done this? I'm a bit of a contrarian by nature, but of course the same reasons that made it really hard to launch a fund were the same reasons why we can buy Angling Direct at a crazy valuation like that and generate those returns of thanks to our early investors.
Yeah, and a lot of these companies, that kind of company, are too small to be bought by some of the larger funds and the larger trusts.
But yes, by the larger funds, yes, but interestingly not by larger strategic acquirers. We've had 3 acquisitions now in our first 3 years. We had nearly our 4th just this week with Audio Boom, which is the podcast publisher I mentioned.
That's still your top holding.
Yeah, that had 3 confirmed now publicly, 3 cash bids, but the board, who own 6% of the company themselves, deemed them not representative of the accelerating growth and margins in the business. So they refreshingly actually rejected the offers and are going to go it alone, and I think go and acquire other podcast businesses themselves. Yeah. But again, when we invested in that, it was on 0.7 sales. It grew profits at 50% last year. We think it'll grow them by even more this year. And Netflix, Spotify, Fox have been acquiring podcast businesses on multiples of sales. So there was it was really a US business, but listed in London, so therefore traded at a material discount to where its peers trade. So just another gem amongst the rubble.
Yeah, interesting. Now it's a very concentrated portfolio, 22.
Correct.
22 stocks. Tell us about something that you've bought more recently. Something interesting we haven't heard about and isn't here on the top 10 list.
Oh, now you've got me. I don't think Mincon's quite on the top 10 from memory. It might be number 11.
Just
As it just
slid in
picked in.
there. But it is only 5% of the portfolio.
And it's very recent. So this, again, is in the camp of... what's particularly interesting about this one, usually when we think we found a gem amongst the rubble, people have heard about it but missed something. This stock I mentioned to people and they look at me like I've got two heads. Like, well, tell me more about this Mincon thing. It's a £100 million capitalised business, dual listed in London and the Euronext, and it has some of the best copper and deep bore construction drill bits in the world. In fact, they're so good that this year they've announced that Epiroc, which is a larger peer, 10 times the size of Mincon, is having to use Mincon's green hammer technology to do its deeper drilling. Having tried to crack the technology itself for 10 years, they're now on trial with 12 Epiroc customers. We obviously hope and believe that will go well, hence making the investment. But when we first identified the shares and put it in what we call the nursery, which is the investments that aren't in the top 10 that we disclose, we bought them about 35 pence per share. They'd been £1.50 4 years ago. At 30 pence per share, they were at a deep discount to tangible value. And then we made it a core holding, and hence it appearing in the top 10 now. In February this year, as our conviction grew on really a recovery in copper mining, a recovery in margins, and growing evidence that their IP was real. And there's no bigger compliment than a peer having to begrudgingly buy your products off you.
What about mistakes? We've talked about 3 really great buys already, and Mincon is already up 27% since you bought it, right? So that's marvelous, but it can't always go well.
Sadly not.
No.
We've definitely made mistakes, and it's going to sound like a cliche, but that's been one of alongside.
Has it been a learning experience?
No, it's more than that. It's been a joy. Alongside some of the support and the counterparties and basically people I've got to work with in launching this and sort of break out from a desk job at my old shop, I've developed more as a fund manager in the past 24, 36 months than 10 years before. And that's because I've directly made mistakes. And yes, it's a cliche that you learn from them, but you really learn from them when they're yours and they're very public. And I describe to friends and family who aren't in the finance world that the job is akin to running a high street store. And in a big glass window every day, you have to put your P&L, what you're selling, what you're not, what you're losing money on. And you have to walk past it 5 times a day. Your friends, your family. In fact, they can look on their phone and see it. Your rivals, your peers, your advisors, your customers. And that takes a certain fibre to your soul, actually, I think. We have got, we've made mistakes, particularly bad ones are where we've almost tried too hard. So there was a business called RBG Holdings. They had a distressed balance sheet. It was a legal services business. It used to have cracking margins. The founder returned, the namesake of the business, a chap called Ian Rosenblatt, and we really backed him to strip out the cost, win back the key clients, pay down the debt organically. And if you did that, it was from memory, a business that not long ago did a 40% margin trading on 0.1 of sales. So it would have been a cracking return if it got anywhere near 1x sales or 2. But in hindsight, it was a bit of an attempt at a hero trade, and we were trying too hard, I think. So that was one. Another very recently, it's one we partly got wrong because actually we took profits along the way, fortunately, and that's one of the great things about having colleagues. They encourage you to do that sort of thing. But there's a business called Synectics in the portfolio. It's still there today.
It is still there,
and we're down, I think,
there,
about 20%.
You are down on this latest fact sheet, 20.9%.
No,
it's recovered a bit since.
That's 0.9 out of 20. We'll call it around 20. And when we invested in the company, we'd identified it had, again, gem amongst the rubble, some world-leading software and cameras for security, mainly around casinos. But that in the modern world we live in, those techniques and products could be applied to other sites like metro stations, hospitals, data centers, infrastructure sites. The stock was going through a purple patch, earnings upgrades. Here we go. We've called this one right. Fantastic. And then the chief executive, very tragically, sort of died overnight. And the business that purple patch has within 12 months come to an end, and it's now so the business is now sat on a loss rather than a profit in terms of our investment, and we are now back to the brutalist investing comment earlier on. We're at a bit of an apex in our journey with Synectics and sorting that out and reformulating the strategy, getting back to basics. The business isn't distressed. It's got 14 million of cash on the balance sheet. The market cap's about 30 today.
And the management are happy to speak to you?
They're speaking to us, yeah. And the board in particular, we like to deal with non-executives. That's their role, and we encourage them to take that up. And because the business does have that IP and a margin of safety, we've got options to review the best way to maximize value in the investment. But in hindsight, should have taken more profits on the way up than we did. But now stepping into, and I'm pretty confident we'll exit the investment with a profit, but it's requiring a lot more time than buy and hold to do so.
Yeah. You said earlier, before we started recording, actually, we were talking about podcasts and listening to podcasts and how much you drive, suggesting that you spend a lot of time on the road visiting prospects.
We do. And funny enough, just yesterday, I was up at 3:30 to drive to the airport to fly to see some prospective clients in Edinburgh, funnily enough. And then I got back about 11 o'clock last night, and here we are today. But the more fun traveling is the site visits, and you do get some almost sort of caricature type moments where the penny drops.
When you go on these site visits, one of the things, I was at a conference yesterday, and we were talking about how AI is the new ESG, in that until relatively recently, every time you went to visit a company, you'd ask them about their ESG policies, and they'd mutter away for a while about all that. And now every time anyone goes to see a company, they say, well, how are you using AI? And presumably you're asking that question every time you go to see anybody. No, you're not.
If anything, I get slightly sheepish when someone brings it up, because it's become a bit of a buzzword, like crypto was a few years ago, and ESG before that. I think what most people call AI is just good automation, if I'm really honest. And good automation I'm all for. But back to one of the ways we find ideas, there's things we use to weed things out as well, and AI isn't one of them. But that it's really, having done it 12 years now, it's fascinating some of the little habits and tricks you can spot in the way a company communicates that can let you sort of look around corners. I mean, the classic is broadly in line, or however moreover in the outlook, and you just go, oh God, 6 months' time is going to be a disaster.
Yeah. Okay, interesting. I think that's a good tip to end on. That's a good tip for negative stuff. You've got a good tip for something positive to look through. For the ordinary investor going out, attempting to do a little bit of what you do, filtering through hundreds and hundreds of companies. What's the number one thing to look at from management?
Follow the money. Go and look at the LTIPs, which is for code for how the management team get paid. If there's triggers or thresholds or share prices that they have to hit and they look interesting versus where the shares are today, always worth investigating.
Okay, interesting. Laurence, thanks very much.
Thank you very much.